Today, we're going to be looking at trend lines and counter trend lines. That is what our focus for today would be on. So it's so far it's been progressive. We started out by looking at candlesticks, trying to see how we can understand candlestick trading, how we can we listed up three major candlestick formations and how we can trade them. Then in the last class, we talked about support and resistance, and you can now match pair them together. You have your candlesticks with your support and resistance, and you have a higher chance of a probable trade. Today, we're going to be looking at trend lines, and as a bonus, we're going to talk a little on counter trend line. Now, you don't want to pay attention to this because this is one of the um, key areas that pro traders use. You have to understand trend lines. And then if you can understand counter trend line, although we'll probably talk about counter trend lines specifically on a subsequent course, or if you get the idea behind this, you'll be able to enhance your trading performance. So let us proceed. And it's important I put out this disclaimer that there are risks associated with forex trading, and so you want to be aware of that. With that said, this is the content of what we'll be discussing today. Understanding trend lines, how we draw trend lines, trend line trading strategy, that means how we trade trend line as a bonus, would now look at counter trend line tradings. Okay, I hope you can all hear me. Now, trend lines. Trend line is the kind of strategy, it's a strategy because of the way the market moves. Now, when you think of the forex market, let me use this word picture to kind of explain it. The forex market is like a river. So, unlike the river, they usually flow in one direction. But the forex market is like a river, but this time it's a river that can flow in different directions. So it can be flowing forward, and then at some other time it can be flowing backward. But and then the current is not always the same. So sometimes it's flowing really, it has really strong current. Sometimes the currents are just weak, but it is never standing still. Now, if you want to swim in this river, I'm sure you know that you would have a better chance of have a better time swimming in the direction of the current. So if you want to swim in a river, you'll be better off swimming in the direction of the current. If you're swimming against the current, then you probably need so much energy and you probably burn out. And that's the way you want to approach the market. You approach the forex market, you want to approach it like a river. You want to know the direction the river is flowing in at that particular time. And then you want to swim in that direction. So if you know the direction the river is flowing in, then you probably now consider, okay, when do I jump in? When is the wave? As the wave pass, should I jump in now? Should I join the next wave? That is how the forex market is, and this is how you should approach it. Now, trend line help us to be able to do this better. Now, when price gets to these trend lines, we'll go to the chart because most of our talk today will be on the chart. When the price gets to a trend line, it usually does one of two things. So it bounces off the trend line, which means it obeys the trend line, or it breaks the trend line and then move in the opposite direction of the current. So when it bounces off the trend line, it means the market just retraced and continues in the direction of the trend, or the river continues in the same flow. But when it breaks the trend line, it means it got to the trend line and then broke the trend line, and then the river reversed and started going in the other direction. There are two different trading strategies. But for this course, we'll be focusing mostly on the trend line and how it works in terms of obeying the trend line. Let me pull up a blank screen so we can see, do some drawing on it. Now, like we've looked at previously, we know that the market moves in waves. So the market moves from point A to point B to point C to point Z, like that. This is kind of how the market works. And then from our last course, we saw that it tends to come back to the same area which serves as support. Don't mind my drawing, but you get the point. So it tends to, come back to the same area. But if you notice too, it also forms an angle. it forms an angle. So if I try to draw, let me remove this. If I try to draw a line that cuts across the bottom, you would notice that the markets keep bouncing off areas of support in this case. So this is kind of how it works. So the market is in ascending order in this particular drawing and illustration I'm giving here. And then it keeps bouncing off support, which kind of happen to tally, but it also forms an angle. Now, what this does for you is this. You now you now have this. Remember, all of this has not happened. So here it's unknown. So what we're looking for is what the market will do the next time it comes back to this trend line. That's simply how the trend line works. So we're looking at the market maybe going up and then coming back to the trend line. Now at this trend line, because we have 1, 2, and 3 here, we'll be expecting a fourth reaction here. Remember, if we say the river or the market flows in a direction, in this direction or in this particular example here, you can see that the market is flowing to the north. The market is flowing higher, it's going higher. And so what we're looking for, we're looking at the market that is trending higher. And then in the market that is ascending, what are we looking for? We're looking for opportunities to buy. So if the market is moving higher, we're looking for opportunities to buy. You don't want to be selling a market that is strongly moving higher. So that means at this point, we'll be waiting to see what the market does here. Now, if you line this up perfectly, you would see that there should be a support level here. And then there's another support level, which is the support of, so there's a horizontal support, and the trend line happens to fall around that area. And so what we're looking for is what does price do at this point? Now, at this point, if the market forms a bullish formation, maybe a bullish pin bar, maybe a bullish pin bar, okay, the jargon is getting too much. Let me take some of this off. Okay, so if the market forms a bullish pin bar or a very bullish engulfing candle at this point, like we learned from our previous lessons, it might now give you an insight into I think the market is going to head again to the north. And so you can now place an order to buy or enter the market buying at this point or somewhere around. Now that is exactly the way the market works. Now it's quite similar when the market is trending lower. So if the market is dropping, that means in a bearish market, it like we said, it doesn't just move from point A to point B in a straight line. It doesn't do this. Instead, what you find is the market will do this. And so we know that this serves as areas of resistance, areas of resistance. In the same way, it also forms an angle that we can trade. So you can see the market bouncing off in this time resistance. So this trend line has been serving as resistance, resisting price from going any further. So when price pulls back and comes to the trend line, it pushes it down. So it pushes it down here, does the same here, does the same here, does the same here. And that is how trend line is. Now, in order to draw a trend line, what do you need? In order to draw a trend line, you need two things. First of all, you need two highs or two low. First of all, you want to establish the direction of the market. So if the market is an ascending market, then you want to, if the market is moving higher, that's what I mean by ascending markets, then you will draw your trend line at the low prices. By low prices, I mean the pullbacks. So your trend line will be under in a market that is trending higher. Now, if you're in a market that is descending, your trend line will be above the market because the trend line will be serving as resistance to push price down. So, so this is a descending, a bearish market. Your trend line is above You're trading the pullbacks, the tops. And then in an ascending market, you are trading the bottoms. And this is, you remember, like we've been saying in this class, your goal as traders is to buy low and sell high. So if you put that into perspective, if the market is descending, this gives you a high price to sell, gives you high prices to sell. Those areas, I don't want to be selling the market at this point. No, because it's still very low. So I wait for the market to give me a new high price, and then it gives me an opportunity to sell and also give me a place to place my stop loss. So in this case, it's that's another strength, one of the beautiful thing about trading of trend line, because it gives you an area where you can place your stop loss. So if you see the market do this, then let's say you enter the market at this point, you place your stop loss above that trend line there. So you have an the area, this is your risk, and then maybe this is your reward. So you can see the difference between why am I drawing, Sha? So this is your reward and this is your risk. And this is why you have to wait for the market to make high prices when you're selling, so that you can have low risk and higher reward. But if you decide to sell a market that is already really low, this is very challenging. So if you sell the market, let me take some of this off. So if you sell the market at a much lower price, your risk becomes higher, because the safe place to place your stop loss would be above here still. All of this becomes your risk. And then what will be your reward? Maybe you'll be targeting something lower. So you have a risk to reward that is not proportional. The goal is to try to get your risk to reward. So you want to do, your risks should be at least 1:2. So if you're risking one, you should be aiming to make two. And this is not just being greedy. It should make technical sense in your trade. That is how you become proficient trading. Anybody can make money trading just one pair you on one time. But over time, if you keep trading a high risk pair with maybe you're risking five in trying to make, let's say you're risking five and then you're trying to make one. Even if you win 10 trades and lose two, you will still be in a loss. And this is the reason why you want to target lower risk. And this is what Trendline helps you to do. Okay, now let's go to the chart. Enough drawing for today for now. And let's go to the chart and see if we can spot some things here. Okay, okay. So I think this was the chart we were using yesterday to do support and resistance. Now, the first thing you want to do in drawing your trend line is identify the market direction. Identify the mid-term market direction. And in order to do that, you want to use a higher time frame, at least the daily time frame, or maybe the weekly or 4 hour time frame. But let's stick to the daily. Now, you don't need to go back too much. So if you have, like, currently, you can have a market that is in a downtrend on the monthly time frame, but in the daily time frame is in an uptrend. You're not trading the monthly time frame, you're not trading for that long, so you probably want to concentrate on the daily time frame. Now, when you see a market making higher highs and higher lows continually, then you know the market is in an uptrend. And then when it's making lower lows and lower highs, then you know the market is in a downtrend. Now let's use this. Let us use the time from, let's say, between here and, let's say, here. Okay, I can pick that. Okay, yeah. Okay, now you can see that within this period I specified, you can see that the market is in a downtrend. By downtrend, I mean you can see that the market has been heading lower and lower. So in heading, let me pull up something. Okay, so you can see that the market has been making lower lows and lower highs. So this is what I mean. You can see that the market has been making lower lows and lower highs. Like it has been moving down. And like we talked about, it doesn't just move down in a straight line. So with this, you can now say, okay, you know that that market is in a downtrend. So when the market is in a downtrend, like we said, your trend line will be placed above the trend line will be placed above the price. So in this case, your trend line will be above. Now, how do you draw a trend line? When you need to draw a trend line, you need 2 points. Remember, you're drawing a trend line so that you can estimate what will happen next when the price gets to that level. So in this case, let me go back to our drawing board so I can just remove all of this. Okay. So in order to draw your trend line, what you need is 2 points. So you need the markets to make too low price in an uptrend. So if it's an uptrend, what you want to see the market do is make too low price first. So once you see the market make too low price with that you can connect together, then what you just do is draw a line that cuts across them. They are the tip of them. Now, why you're doing this is it's not just so you trade it. So it's so that you can see what happens the next time price gets to that level. So the next time price gets to this level, remember you've already drawn this line. So the next time you see price approaching this level, because you have this line in place, you can now start looking for what will happen at this area. And then when you see something favorable, you can now join the market and head higher. So in the same way, go back to our chart. If let me zoom in. Okay, wanted to use this. Okay, so in this case, let me we have too low price. The market or you have you have something like this. This is not exactly clean because it's a trend line break here. Let me look for a pair that cleanly explains what I'm trying to say because I want to try and make this clear as possible so you can spot it easily when you see it on your charts. Okay. Now, if you look at this here, you would see, at least I can see that there is a trend line here. And so what you're doing is you're connecting two low price. Now, in this case, because this has already happened, what I'm trying to show you has already happened. How I would have drawn this trend line if it was just happening would have been more like this. Now, remember, this thing is not exact line, it is region, so it's zone, it's just like zones. So you see when price come close to this area, it usually tends to push the price higher. Now, when you see this happen 1, 2 times, you draw your trend line and then you wait for the market to get to that point again. So you see the market pull back to this area, pushes higher, pull back, pushes higher, pulls back, pushes higher. So after 1, 2, you have this trend line in place. You're looking at what will happen at this point. And then if we zoom in a little bit and see whether there's any clue, if the market gave us a clue, in this case, it made a U-turn. So it didn't give us a clean break except up until this point, but it made a U-turn that can now signify buying. Now this is not as clean as I would have loved. Let me look for something easier to explain. Okay, I think we have one here now. Okay. Okay, now so if you look at this, after the markets touch this price this first time, you will draw your trend line. Now, when the market gets to that level again, which wasn't very far, you can see what happens. So after it pulled back here, you put in your trend line. Then the next time, let me make this sticker. The next time the market gets to that trend line, you can now start anticipating price movements. So the market's heading lower, got pulled back here and made a U-turn. Then you draw your trend line. You wait for the market to get to that level again. And then when the market gets back to that level, and then it gives you clue. So when you get to that level, in this case, it forms a dark cloud cover, this formation here is called the dark cloud cover, and they form the dark cloud cover and push price down. Now you still on this pair still wait to see what the market do at that level. So the next time the market got to that level, it actually struggled to go past it, but then it eventually broke above it. Now when the market breaks a trend line, it now usually turns the market that's pair in the opposite direction. Remember, trend lines has support and resistance as well, but the difference is that they are not horizontal; they are diagonal. So just as support turns to resistance if broken, and resistance turns to support if broken, when a trend line breaks, when the resistance, the top of a trend line breaks, it usually becomes support. And you can see when market finally broke the trend line that has been keeping price lower, it started pushing price higher. And that's why you can see price heading to the north in this case. Now, if we look for more examples, okay, I had one here that I drew. So, okay, let me make this chart black and white. Take this off. Now, look at this carefully. You'll notice I had drawn this trend line a while ago. After the market pulled back to this region, so you draw the trend line. Now the next thing was to see what happens the next time the market gets to this. In this case, the market did not reject the trend line. Remember, we said when the market gets to the trend line, it does one of two things. It either breaks, either continues, rejects that level and continues in the direction, or breaks below it. So what you want to see if you're trading trend line in the direction of the trend is to see the market reject the trend line. Like in this case, the market completely rejected the trend line, and you see how it forced price higher. So when the market gets to the trend line again, you're waiting to see what the market does there. And if it does something favorable in terms of a bullish formation, then you want to enter the market selling or buying in this case. So that is how the trend line works. So you look for two low prices if the market is in an uptrend, and to figure out if the market is in an uptrend or a downtrend, you want to use a higher time frame like the daily time frame and see if the market has been heading higher. Actually, in this case, the market has actually been heading kind of sideways. So it has been heading lower if you look at it, but not gaining so much ground. So you can have a trend line that cuts like this, and you can have remember we joined two high prices in this case because the market is in a bearish momentum. The bears have it here. So you see, I connected 2 points. In this case, I'll be waiting for the market to get back to any of this level. So connect this one, two, or one, two. Now, since the market moves in waves, what you could see is the market push back up and come back and retest the back side of this trend line. And when it gets here, it will either do one of two things, break and come out to this outer one, or push back down. So when you line this up with your support and resistance, that is when you now have a great trade. Now, if you add our support and resistance to this, like if you draw your resistance line here, you would understand why the market really rejected that level. You can now see that this area is an area of interest. And so when the market got there, there were more than one reason for the market to push back down because that place is an area of horizontal resistance and also formed a bearish candlestick formation at a trend line. And you can see how that forced price down. So when you have one, two, three, a combination of signal of things giving you the same market direction or the same signal, then you have a quality trade. If it doesn't look as clean as you would like it, it's probably best for you to leave that and look at another chart or wait for a better opportunity to occur. So remember, you want to the way you draw your trend line is to look if the market is in an uptrend, and you can see here the market has been moving higher. So from this point on, the market has been in an uptrend. But from this point down, the market has been in a downtrend up until we got here. Just like the river we talked about, that doesn't flow in one direction forever. So the market, which has been trending lower, at some point would stop trending lower and start trending higher. So in this case, you would have I currently have this on my watch list and to see what the market will do at this level because if the trend line does break, which is looking likely, If the market does break this trend line, it would rain pips, rain at least 1,000 pips on this pair, at least in the coming months, if the market breaks this trend line. And this is so because you can see how this lines up here. You can see how this lines up. The area the market rejected here is an area of interest. So this level, which has been serving as resistance, keeping price lower after this bullish rally. So the bulls or the buyers have rallied price up to this point without even looking back. And then it has formed a very, very steep trend line. Now, buyers are struggling to keep price above, and they are also trying their best to ensure that price does not break lower, because if this break occurs, you could now see the market comes back, we test the backside of the trend line, and you would see the price move at least 50%. At least you could see, I anticipate if that break occur, you probably see the market going down to at least 66 80 region or something. So this is how you draw your trend line. You look for two price, connect them together, and wait for the market to reach that level again. So when the market does reach that level again, you can now combine what you've learned in price action and your support and resistance, and then you can find yourself with a very good trade in hand. Let's see if we can look for more examples to explain this. You can see this here. Okay, let me do this. If I can. Yeah, you can. This is a classic example of a. So you can see what this. I think I can pull this up here. No, it wouldn't make sense. So you want to pick the highs, the tips of the candle. Now you can see what has been happening here. The markets pulled back, came back, rejected here, and then you would have drawn your trend line. So you draw your trend line. Remember, you're drawing your trend line in anticipation of future direction. So once the market comes back to that area again, you can see how that same level reacted. In this time, acted as resistance and pushed price lower. This move from this trend line level here to here was about 100 pips. That was 100 pips in like 6 hours or 7 hours. And this is because of the rejection of this trend line. Now, just like I said earlier, when the trend line eventually breaks, that same trend line that has been keeping price down would now hold as a cushion, would now serve as a cushion to keep price up. And you can see clearly how when the market finally eventually broke above the trend line, it came back, tested the backside of the trend line, this time as support, and it pushed the price in this direction. So in this case now, what I will have here is another trend line, because you can see now that the market is moving. All of this time, the market has been making lower lows and lower highs. But if you notice from here, the market has not made another lower low. It has only been making higher lows, because this low is higher than this low, and this low is higher than this low, and so on. So you can see that the market is now pushing higher. So I'll probably have another trend line in this case that moves like this. And then you can see how this new trend line, which came back here to retest this one, is now serving as support. So this is how the market, like I said, it's like a river that transitions from flowing forward to flowing backwards to standing to moving in a rectangular motion without moving so far. That's how the market works. So it goes from flowing higher or moving downwards to then moving upwards or to consolidating. And so you draw your trend line. Your trend line will help you to identify the market momentum and the market direction. So now in this case, if I were to trade this, I'll be looking to see what happens the next time the price gets here. And since this is the 1 hour chart, it might not take so long, maybe a couple of hours, or maybe okay, today is Friday, so maybe by Monday we can see price will test this level. And when price will test this level, you might want to. Okay, in this case, I may not be looking to trade this buying, because the market is actually struggling to go past this level. So what happens when price gets to this level? If it forms a bullish formation and rejects this level, then what we could see is we could see price trend higher. If it breaks this level, Then you could see price come back, test the backside of this, and start heading lower. And that is how the trend line works. You look for two low price and connect them together. You look for two high price in the case of if it's in a downtrend, look for two high price and connect them together. If it's in the case of an uptrend, you look for two low prices at least. It can be more, but at least two low prices or two high prices, connect them together. The more touches you have on your trend line, the stronger or the more valuable that trend line is. So in this case, you have the market pulled back here. So after these two, you can draw your trend line. You wait to see what happens there. But in this case, you may not have drawn the trend line because the market was still in a downtrend. Because this trend line has been keeping price. Remember, if all of this had not happened, let's assume the market was still at this level, there will be no need to connect these 2 points together because the market has clearly been in a downtrend. So what you just be waiting is to see what happens the next time price gets to this level. And when got to this level and form this rejection, you might now look into selling. You will sell to the next support resistance level. In this case, the next support level. So maybe you sell to this point here, to somewhere here, and then what happens is you place your stop loss above there, and then you can see price pulls back, gets to that level. Normally, you're probably expecting price to go lower, but then if you see price break this trend line, you should now turn away from looking for selling opportunities and stay away from the market. And then you should now probably be looking for buying opportunities. Once the market breaks the trend line, you can now see it look moving in the opposite direction. This is when you can now draw your new trend line, this time ascending trend line because it has broken the previous trend. And then you can now see how it now started pushing price in the opposite direction of the trend. Now, this is very, very important. If you're going to be any better at trading, you need to understand the way this works. When you combine this with all of the other things you've been learning and some probably new strategies, you would now have an edge. This is how you define your trading edge. So you can now personally decide, okay, I want to be trading a combination of trend lines or normal support and resistance and candlestick formation. So if I draw my trend lines, I want to watch for what happens on these trend lines. I want to see if it forms a bullish candle or a bearish candle, depending on what the market is doing. And then you want to now take a trading decision. So that is how you trade. That is how you draw your trend line. And how do you trade the trend line? Now let's look at how we trade the trend line. And when you've decided that a trend line is going to hold, by hold, I mean the market has gotten a trend line, and you've seen it has formed that the market is going to continue in the direction of the overall trend. In this case, going down. What you want to do is you have several options to enter the market. So in this case, you can once the market has formed this pin bar, you saw this pin bar rejection. You can now place your order, maybe 50% retracement, or just sell at the close of this candle. You sell at the close of this candle, your stop loss would be above this candle. Not just above this candle. You have several options to place your stop loss, but at least it has to be above this candle. You can also use the previous swing high. That means the most recent high you can see, which is in this case would be this high. So you can place your stop loss above this high, and your target, at least your target should be the next support level, or in this case, which will be here. Or what you can do instead is, if you've already drawn your support and resistance level on your chart, you would have seen the levels of support and resistance. Okay, let's go to a higher time frame. If you've drawn your levels of support and resistance on your chart, then you probably know areas of support and resistance that you are looking at. And then you know where to probably place your stop loss. So you'd have known that, okay, such so and so area is an area of interest, and I want to look out for what happens at this area. And that is where you probably place your stop loss. Now, when you probably have gained some pips in the market. Like if you place a trade, let's say you sell this pair, you place an order and you sell at this point. Let me use this one. So you sell at this point, and maybe you're targeting this low here because that is a significant level on your chart. Now, all of these places you've been in profits. You would not probably want to give up those profits, and you can easily set a trailing stop. So what I mean is, if you take an order and you sell, let's say you can close your profit, you can lock in some profit and move your stop loss closer to your, move your stop loss at least to your entry price, or maybe move your stop loss to, so that in case the market even goes and hit your stop loss, you would still take a profit. So if you see that the market has moved in your direction, you don't want to just leave your stop loss where it was. You want to adjust it closer to the market, so that in case the market reverses, even though you lose, you will not make all the money you'd have probably made, but you will not lose. You probably make some gain. But you also want to be careful so that you don't move your stop loss too quickly, and then you see the market pull back, take you out, and then continue your direction. And that is how you approach the trend line. So once you've figured out that the market has rejected the trend line, you enter the market either with a pending order or a market order, and then you place your stop loss. If it's in a down a bearish channel, you place your stop loss above the trend line. Then if it's in an ascending market, you place your stop loss below. So if after this candle we see what happens here, and then we place a buy order, our stop loss will be below this candle, at least below this one, probably even below this one. Then our target should be at least the next resistance level. So this is, you want to know what your stop loss is, how far it is, and what the monetary value is. So if you after you've decided where you're supposed to place your stop loss, and maybe your stop loss is 54 pips, let's see that, and then your target is maybe, let me see, if your target is another 54 pips, that doesn't have good risk to reward ratio. But let's say if your target is 150 pips, then it makes more sense. And this is how when I say risk to reward ratio, you want to look at, okay, before I enter the market, what am I risking? If the market goes against me, what do I lose? What am I targeting? If the market goes in my favor, what do I stand to gain? So when you look at it and you say it makes sense, the risk to reward in this particular trade is okay, then you can execute your trade. If the risk to reward is not okay, you're probably best leaving it, because you don't want to form bad habits where you're taking trades that do not make financial sense. So there's always going to be opportunity in the market. So if you miss a trade, that's not the end of the world. Another one would come up today, the next day, even if not on that currency pair, you have over 50 different combinations of currency pairs to trade. So you will probably see something interesting in one of them that you can execute. And that is how you approach trend line. Now I'm going to come back to my screen and see if I have questions. Yeah, you can draw several trend lines. So you can have a trend line within a trend line. What I mean is, that is an answer to Linda. You can have, so let's say for example, so let's say for example you have the market make, so you have the market move something like this, then move like this. Now remember, we are connecting the lows in this case. So you're connecting these 2 points together. So this will be a valid trend line. That means we'll be waiting to see if the market, comes back and retests this trend line. But this is also, there's probably another trend line here, although my drawing is not like I would have wanted. So you can have this trend line keeping price up, and also this one, which is like the mother trend line, you know. And so what happens is this: if the market gets to this trend line, remember what you're doing, you're not just trading it once it gets to that level. You're looking to see how the market reacts to those levels. So when the market pulls back and gets to that level and rejects it, then you can now, buy it and continue in that direction. But sometimes you can have the market break this trend line, come back, retest it as resistance in this case, and pull back to this mother trend line and then continue upward. So that is why we always wait to see what the market does at this level. So when the market rejects here, you stay away. You might decide to sell at this point if it makes sense to you. So you can, if you break the trend line and retest it, you can decide to sell in this direction. also keeping in mind that this trend line here might also force price in this direction. So just because the market breaks the outer trend line or the inner trend line of a smaller trend line or in a smaller time frame doesn't mean that the market has completely gone in the opposite direction. So it might just have done is made a deeper retracement or correction. So, like if you notice in the market is always making waves. So these waves, they are either retracements. So you can see in this case, it just retrace to a level and continue. It retrace to a certain level and continue. The same thing, retrace and continue. But it will probably not do this forever. At some point, it is going to break that flow. It's going to break that flow and that trend line. So if it breaks that flow, it is no longer retracement. It has turned to breakdown. So the market has broken away from that momentum that shifted. Now, when it does this, it can continue moving side to side. It can do that, or it can now start moving lower. So when you draw your trend line, these are not definite areas, treat it, but you're looking, just like with everything, you're looking to see several things confirm to you that the price or the market is rejecting or reacting to that level, and then you can make a trading decision. So if you break the trend line, you want to look at the market and trade in the direction that the market has broken in the direction. And if it continues on trend line, you want to be buying. In this case, because we are looking at an ascending market, we want to be buying the low prices. You can see that these are low prices. The market comes back and forms a low price. The same thing, it forms a low price. It forms a low price. Too much noise here. But that is how it works. The market always comes back and form low prices. Okay. So it comes back from low prices if it's an ascending market, low price, low price, low price. So we're looking to buy this low price because this gives us the best return for our money. Because if you imagine if you had bought the market at this level and you see the market coming down like this, and maybe you place your stop loss here. So what will happen is you say you place your stop loss at this level, the market will come back, take you out, and then continue in this direction. So what you're waiting for is for the market to form those low prices if it's in an ascending market, and then you buy those low prices. But if it's in a descending market, that means a market that is coming down, we want to be buying the high prices. So we're waiting for these high prices, which in turn forms a trend line that we can trade, and we want to be selling the high prices. So the idea is buy low but sell high. That is how you make money trading. You don't want to be buying high. Even if you're in business, you're not looking to buy things at the high price and sell at the low price. You're looking to buy at the low price and sell at the high price. It's the same thing you're doing business here. You are trying to buy at the low price and looking to sell at a high price. And that is how profits is made. Okay. So okay. So if you have questions, are there any questions to what we've talked about so far? Who doesn't understand trend lines? Let me see. Okay. So, but like with everything we've talked about, a combination of all of it is what is key. So, if you look at the price action we talked about, interesting. You combine it with support and resistance, we explained. Perfect. And then when you combine it with trend line, you can now have so if you see, imagine seeing a bullish candlestick at an area of resistance. That is not supposed to interest you that much because in area of resistance, you're not really interested in, like, if the market is in a downtrend. In areas of resistance, you're more interested in selling. So if the market is in a downtrend, heading lower. So if the market is in a downtrend, heading lower, you're more interested in selling. So when you see the market in areas of resistance, that means places that are keeping price, areas that are looking to keep price down. So these are areas of resistance, these are areas of resistance, these are areas of resistance in a downtrend. So in this downtrend, you see the price form a bullish candlestick formation here, bullish in a downtrend. Just because you know that bullish candlestick usually tend to push price down, you might not you doesn't mean you want to trade this particular bullish candlestick. But if you see the market forms a bearish candlestick at areas of resistance, then in a downtrend, so the market forms a pin bar. Let's say the market forms a pin bar at this level. Then that gives you a clue that this is an area of resistance. Let's say it lines up perfectly with this, and then the market rejects that level, and it also happens to be that that level also is okay. This is looking very rough. Okay, so we say this level, this is where we draw our trend line. So you can have your candlestick touch the trend lines, and then you see the market form a bearish candlestick formation here, and that level also happens to be on your chart a key level, and then you see the market form a bearish candlestick at that position in a downtrend. This gives you have a better advantage or a better probability of seeing the price push lower. You now probably see the price heading down to the south. So the mistake most traders do is you see a market heading higher, so you see the market you see two, three, four, five big candlesticks, and you're like this market is going up, 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 and they buy. And then what happens is they are buying at a high price, and then the market will pull back. But you see the market heading lower, making several big low bearish candlesticks, and they say, okay, the market is going to the moon, and they sell. And what happens is the market is at a low price and they are selling when they're supposed to wait for the market to make high prices. So understanding support and resistance, understanding how trend line works would help you to be able to gauge where low prices is and where high prices is on your market. So like what I was trying to explain now. So let me use this example now. So imagine let me use here. So imagine seeing this candlestick. Imagine seeing these candles. So somebody comes and see, the market made one big candle, another big candle. I will just buy and it will go up to the moon. But that's it's not what the market is planning because the market is in a downtrend. What they did not understand is the market just did a pullback. So what happened is the market only just pulled back to a new high price and formed a high price here. Because the market is in a downtrend, they should be more interested in selling. So when it pulls back to form a new high price, we should be looking out for opportunities to sell. And then in this case, see where our let me erase all of this. Our bearish signal came into play. Okay. So now in this case, you have the market now formed. This is a bearish engulfing. Even if you had sold this pair, remember our stop loss will be above here. You can see how the market never got there. Although it did not go down straight, this formed a bearish engulfing at an area of at a new high price. This is in a down market. Again, it formed a pin bar here. So if you had traded the pin bar, either traded it instantly or traded the 50% retracement, or if you had traded this engulfing bar, then you'd have ruined all these pips. But somebody who doesn't really know much about trading, we just see the market heading up, 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 and then what happened? They want to buy. So you see, it forms two, it's going up, and then you see somebody buys here, or sorry, you see somebody buy at this point, and what happens? The market refuses to go up, and actually the market comes down, and then they lose a lot of money because of ignorance. So that is how Trendline enables your trading much, much better.